Hi, this is Zach here with the Bulletin Board Heroes for Thursday, the 9th of March. Starting on with the FTSE 100, where we seem to have a bit of a change here. Broken that uptrend line in the RSI window, which has been in place since October, so that's quite significant. Broken that resistance line there from October as well, around the 7,900 level, and below that 7,900 level, there's the risk of a test of the 50-day moving average at 78.30. Below that, we would be thinking of 77.20, which was late January support. On the upside, we want an end-of-day close back above 79.60 to give us a chance of getting through 8,000 again, and maybe up to 80,200 by the end of next month. Moving along to the DAX, which has outperformed the FTSE over the recent past. Here, even though it's down a bit today, here we had a gap higher to start the month. And we're holding above or holding near the main resistance, 15,600. Above that, looking for 16,000, and above that, maybe by the end of next month, up to 16,700 at that September resistance line projection. On the downside, there is the gap to fill there down to 15,300, and then the 50-day moving average around 15,200, which kind of makes sense as that's been the support for this market over the last month or so. On to the Dow, which has not looked so good so far in 2023. Here we've got a situation where we failed at the 50-day moving average at the turn of the week. We've also failed at RSI 50, so looking for at least a test of the 200-day moving average at 32,300. Below that, there's the risk of November support down there at 31,700. An end-of-day close through the 50-day line, 33,500, could take us up to the main resistance line, that sort of multi-tested resistance there from November, up at 34,200. But at this stage, we're in a tight range between the 50 and 200-day lines. On to Bitcoin, which is also not covering itself in glory at the moment. Here, if you look closely, you can see that we had the gap down through the 50-day moving average on the Silvergate debacle. We've now broken a line of neckline there, neckline support, around 22,200. Below that neckline, and especially below the 50-day moving average, we've got the risk of a test of the 200-day moving average at 19,700, which would be rather disappointing after the good gains that we had to start 2023. We've also broken that line of support in the RSI window, mirroring what we've sort of seen at the FTSE, and that risks taking this market down towards the 20,000 zone. On to the stocks, and lots of fun and games at Atlantic Lithium with the short attack. Reminds me a bit of the Pantheon shorting attack on that particular company as well. Situation here is that we found a line of support there around the 20, if we look closer, around the 20 pence level, but the actual line there around 23. Above 23, we've got the chance not only of what we've got already, which is testing old support at 30 pence as new resistance. We could flick up to the broken support line there from July, from July there at 35 pence. So 35 pence at the moment looks like the best on the upside, and in order to snap the whole bear configuration, we'd have to get back either above the 200-day moving average at 38 pence or break that main resistance line there from April at 41. But at the moment, probably looking for the low 30s as the destination for this stock. If you're cautious, maybe wait for an end-of-day close back above 30 to look for 35 or 38 over the near term. But at the moment, it looks as though the worst of the current move is over. I hope that doesn't become a curse. Moving on to Avacta, and here we have that painful retreat from the highs of last month. So we're peaking out through 180 and then coming back to the 200-day moving average, which is typical of these kinds of situations. 200-day line, very important in terms of providing support. It's done that now. We had a nice hammer candle yesterday off that 200-day line. I'm probably looking for resistance on the way down in the low 140s, might scrape up to the 50-day moving average of 148 while we make no new lows. But it looks as though yesterday's floor is significant, especially as it was a minor bear trap from below the 122 low of the 6th of March. Next situation is Firering, which had a decent update today regarding getting more lithium at ATEX, more of ATEX rather. Here we've got a situation where it looks as though we've got a break of that resistance line there from back in November. If you're more cautious, probably wait for the shares to get up through the 50 and 200-day moving averages at 8.5. But end of day close back above 8.1 pence, the old December floor, might be a signal for some to follow. If you look back, you can also see there's an uptrend line in the RSI window, which the shares have bounced off, or at least the RSI has bounced off that. So that does suggest that we are either at or near the bottom of the pullback from way up there at 16 pence back in November. So 50% retracement kind of makes sense as well. Moving on to GSTechnologies, which I think I covered yesterday. Here up another 25%. It was a great looking chart with the neckline there around 0.4. We've broken that very nicely. And looking for the main resistance line there from September at 0.57 or 0.58. And really, I suppose through that, it would be 0.7 pence resistance on the way down. But this stage, just looking for the upper 50s, so 0.57, 0.58 over the next week or so. At this stage, only well below that 0.4 pence level delays the upside scenario, or the recovery scenario. On to Genedrive, which I've covered quite a few times here, maybe too many times actually, but interesting chart with that zigzag that we've had since the end of January, very volatile. Current situation though looks as though while we're above that old resistance line there at 25 pence, we're going to head back to 40 pence, or head up to 40 pence, which is a May resistance line projection. We're backed by an uptrend line in the RSI window. That's actually been the most consistent part of the whole equation after the bucking bronco type price action that we've had since the end of January. Onto a stock which doesn't get much coverage, but has got some decent coverage here. Here we've got OPG Power Ventures, and the highlights here of the near term, apart from the breakthrough, the resistance, which was at 7.3 pence, has been the way that we've had a golden cross to start March, rising 50 and 200-day moving averages, and we've had a bull flag breakout, so breaking through that 9.3 pence level, above 9.3, looking for at least 10 3/4 over the next week or two. Big picture target maybe by the end of next month up to 18 pence, and that's said on the basis of the rather punchy call, but said on the basis of the golden cross and the latest breakout there, which looks like a mid-move consolidation, and an 18 pence by the end of next month if we can clear the 10.5 pence area over the next week or two. Only back below around 8.5 pence, really delaying the upside scenario for OPG. Stock which is also quite a rarity here is Pressure Technologies, and here we're rising, and we've had a bear trap from below the 50-day moving average around the 40 pence level. Above that, looking for 65 pence by the end of next month, obviously snapping the rather painful decline for the shares that there was in the late summer. So let's see if the shares can step up to the plate there. On to Pantheon, which is of interest at the moment, given the way that we had another leg down for the stock. I did suggest before that in a bearish situation, you have rallies up to the 50-day moving average, and then we fail again. The key here is probably to look at the initial January support. That was at 37 pence, so that may be the initial target for the shares. If we are able to remain above 30 pence, i.e. today's support area, 29 pence to be more precise. So above 29, looking for 37 initially. Best case would be that we would head up to the 50-day line again before the bears start to throw stones at this stock. On to a stock which I don't think I've ever covered before, which is RA International. Here we've got a good progression within a broadening triangle, which has been in place since May. Top of the triangle there, heading for 28 pence, maybe by the end of next month. The attraction also is the unfilled gap to the upside, which we had at the turn of January going into February, and also we've got that rising 50-day line and support above that. So that's normally enough to get a rally going in a meaningful way. And only back below, really, the neckline there, 14.6 pence, delays that 28 pence target for RA International. A couple of stocks to go now. First is Sirocco Energy, which has been looking rather more perky over the recent past. We had a rising trend channel there from back in July. We've broken through the 200-day moving average very well this week, and above that at 0.26, we're looking for 0.45 plus by the end of next month. So let's see if that can deliver the goods for the bulls. Finishing off with Tertiary, which I covered yesterday afternoon, taking a bit of time to enjoy looking at this particular situation. Here we've got trendline break there from October. That was around 0.13. We've got a rising 50-day moving average, and when that's near the low, that's normally good news. We had a failed gap fill of that September gap, so that's another plus. And all we're looking for now really is a sustained break of the 200-day line at 0.16. If we can get that, then that should be enough to give us a return back up to the top of the range at 0.3 pence, and a nice uptrend line there in the RSI window to back the bulls. That's it from me today. More updates tomorrow.